Right, welcome everybody. Follow that. We haven't got a £10 million comic to show you, I'm afraid. We just have the challenge of fixing capital markets. So my guests on the panel, perhaps to introduce again, Sunidhi, this morning you will have seen Sunidhi launch FinStreet here in this room. Michael Brunn is the co-global head of private equity at Goldman Sachs in the asset management division. And Garth Ritchie is a partner at Centricus, which manages 45 billion, is it? Well, it's probably gone up while we're talking. The old paradigm of markets, when I was a young person, was banks lend to small businesses and capital markets lent to big businesses, and that's changed. Private markets have become a major feature of the market. So, Michael, that's your domain. Why have private markets changed the way the paradigm works? What's the underlying driver of that?
A couple of things. First of all, you're right. I think the markets, both issuers and investors, have voted with their feet. There's definitely a need for a large private market. Since 2010, the broader private equity landscape, be it buyout, growth, secondaries, venture, has grown from somewhere around $2 trillion to close to $9 trillion this year. And so obviously, if people are voting with their feet, there must be something about this market which is very, very attractive, both for the investor and the issuer. And you're seeing a similar trend in private credit. One of the prior panelists spoke about that, where just a few years ago, that was probably less than $1 trillion and has doubled over the last 4 or 5 years. A couple of things. So why do we see this dynamic? First of all, there is a need for a different source of capital than public markets. Many issuers want more time to make strategic decisions. They don't want the hassle of quarterly reporting where they need to be accountable for very short-term decisions and very short-term interventions. They basically want more time to implement more strategic goals. Secondly, there's definitely a need for much deeper value creation resources. And especially if you dive into smaller companies, you'll often find a situation where the talent that they can attract in the public market is at a discount to what somebody that they're partnered up with, like a private equity fund, could allow them to attract. And you can look at that in a couple of different ways. If you are, say, a $1 billion enterprise company, you are unlikely to have access to the resources of a 10 or 20 or $30 billion company. But what about if you team up with a large multi-asset platform that has maybe hundreds of billions of dollars of assets and can attract talent, and it's one of their core competences? All of a sudden, you can inject that talent into the equation, and you can get a much nicer opportunity to create value in the market. And so all of a sudden, you start having the benefit of timing plus the benefit of talent, which overall should lead to better value creation.
Yeah, the talent thing here in Abu Dhabi, we should probably call it the Manchester City School of building a team, yeah? Invest heavily in good people and you might win something.
We definitely agree with that. We basically believe that the best team will ultimately generate the best results, and especially in a market like the one we're in right now, where if you decompose returns into its core building blocks, EBITDA growth, cash flow generation, and multiple expansion or contraction, we're not betting on a lot of multiple expansion from here, so it all needs to come in that ever important EBITDA growth and cash flow generation. And to drive that, you need very, very deep value creation resources. So for that reason, private markets have a huge role to play. And that is just on the private equity side. There are similar dynamics on the credit side, but I'll also leave time for our other panelists.
I mean, Garth, what are the disadvantages that come along with the private markets?
Well, I think if you go back in time, the genesis of the public markets is about 400 years old. It started with the Dutch East India Company issuing bonds. And really, what are the benefits, have been the benefits? Why do people want to go into the public markets? Is ideally it should lower the cost of capital. So there are a couple of things that public markets typically try and conform to. One is lower cost of capital. It's a transition mechanism for risk versus capital. You get price discovery, and with that, maybe you get some liquidity. And that's what we've seen in evolution over time. So what we have seen then is we've seen, certainly over the last 20 years, we've seen a proliferation of companies no longer seeking to go to the public market and being comfortable staying in the private market. Why? Potentially because the cost of capital is not lower in the public markets, one. Two, is this genesis that because something is public means that it's liquid and or safe? is a misnomer. So let me give you an example. I'll take 3 big names, household names in the capital markets. If you take Barclays, Deutsche Bank, and Citigroup. Barclays has a market cap of 40 billion pounds. It trades 120 million pounds a day, 30 basis points. Deutsche Bank has a market cap of 32 billion euros. It trades 100 million euros a day. Citigroup has a $135 billion market cap. It trades $1 billion a day, which is 75 basis points. So by that, you see that there's more liquidity in the United States, which is true across the board. But by definition, you see a price on a screen, but there's no real liquidity. So it's not necessarily safe. So if the cost of capital is actually not demonstrably lower for a number of different companies, and there isn't the liquidity that you perceive to be on a screen, what you've seen is many companies choose to remain private for much longer.
I mean, there seems to me there's 2 types of liquidity. There's the real liquidity, and then there's the structured liquidity we've seen. And one of the features of the last decade has been the creation of liquidity by governments. And now increasingly in private funds, we're seeing structured liquidity to create opportunities for LPs to take cash out of businesses. Now, those 2 different types of liquidity are very different in their consequences for the economy. And where does FinStreet fit into the solution to that particular dilemma?
So I think what FinStreet is doing by providing the infrastructure for private markets, which allow for companies that are listed on the private exchange remain private. So there's a classification of group of investors who can participate in that listing, and therefore it's not necessarily that heavy in terms of regulation, disclosures, etc. Now, what about liquidity? So there's of course competing needs from issuers and from asset managers versus from investors who do require liquidity. And the market, as Michael said, it's grown enormously. And so we know about the old paradigm, we know about the existing paradigm. Is this the time to question how the infrastructure should actually come about for a market which is worth trillions of dollars? So what FinStreet does is really reimagine that landscape, reimagine and question why are these assets called illiquid? They're private assets, that's okay, but why do they need to be called liquid? So liquidity, therefore, is that there's a disparate group of investors in the private market, some of whom who wish to trade. So FinStreet provides exactly that. You can come and you can trade and you can find your pricing. But there are others of whom who do not wish to trade. So let's say you are a founder of your company and you founded this and you believe it's worth $1 billion, but that's not up to you to decide. So if you put your asset on FinStreet, you custodize it, what happens is, because there are some others who are trading it, you get real-time pricing, and therefore it allows you to go and get pledging solutions from the bank, because we are a recognized CSD. So essentially what we've done is really thought through what this private market currently lacks. Of course, everybody can get along with doing what they really want to do, investors, fund managers, and issuers.
So much as we just heard about tokenizing comics, we can tokenize businesses as well. And all assets can ultimately have a market, and whether the screen has behind it some liquidity or not is a different question. But Michael, this structured products in private equity funds, do you think that's a trend that will continue, or do you think it's running its course?
First of all, I think that the private equity market, as remember it 20 years ago, with a closed-end fund and no real liquidity, is just a part of the evolution. We're going to enter a much more plural setting now, where we have evergreen vehicles or open-ended vehicles coexisting with closed-end funds. I think the beauty about having those two coexisting is that there's a much better match to what investors are actually looking for. Mm-hmm. You might be very comfortable as a sophisticated investor, benefiting from ultimately probably the higher return generation and the longer time to mature those assets in a closed-end structure, whilst other people value the liquidity to an extent where they are probably willing to forgo some return in order to get that liquidity. And I think it's very nice to see how we are observing in the market that both structures are having great success, and we're also now starting to see that venture into the retail world to give or to democratize the market in order to give even more people access. However, I do think, again, that it's important that these products are being marketed in a way where people understand the cost benefits of the two. It's very hard for an open-ended structure to replicate the return of a closed-ended fund, because you need those liquidity buffers, especially in the more illiquid asset classes like private equity. In order to facilitate the liquidity, you need to hold a certain amount of cash or higher-ranking securities, and that will be a drag on your return, whereas in a closed-ended fund, you can obviously perfectly time your drawdowns and maximize the IRR. But as long as people understand the trade-offs between those two, it's a very, very healthy and interesting dynamic that you can then also take into new investor classes like retail.
Well, Garth, you raised the largest private equity fund in history, I think. The One Vision Fund was one of yours, isn't it?
Yep.
What's your view on how this will play out?
Look, I think that one of the things that need to be addressed is if you think about asset managers, public market asset managers, is typically 25 years ago, the street was writing a lot of research on small and mid-cap companies. And through the Spitzer settlement and a lot of unbundling discussions that have happened, is you no longer have the sell side writing the same amount of research on small and mid-cap companies, which has meant that for an asset manager, any one of the big mutual funds, whether it be Fidelity or MassFi or Capital, it just makes it harder for them to want to invest in small and mid-cap companies. So liquidity dries up, cost of capital effectively goes up, so you don't get as good an IPO price because you're not going to get coverage across the street. So to the point that Michael was saying, there's no real attraction for them to go to the public markets. So I think what you need to do is that balance just moved too far with regulation, which effectively drove that investment in the capital markets out. My view is that you will see that come back into over time because the capital markets are efficient. So that cost of capital will need to come down. What we have seen is we've seen much larger companies remain private than we have seen in history, the likes of a Stripe or Revolut trading at 45 billion or Stripe at 80 billion or shares trading hands in ByteDance in the 400s by appointment. That's something we haven't seen before, and that's saying to the capital markets as a structure that what has happened for the last 400 years isn't what's necessarily going to happen for the next number of years. But I'm very confident that the capital market is efficient and that will evolve over time.
So Nidhi, we're in Abu Dhabi. How does Abu Dhabi fit into that, what is a really quite European and American market dynamic of 400 years? How does FinStreet liberate assets here?
Well, I think facts are that Abu Dhabi has on its balance sheet trillions of dollars of assets that they own, not just manage. And as well as in the Middle East, I believe in the next few decades, Middle East and Abu Dhabi will emerge as the dominant global player for financial markets. And FinStreet is at the forefront of leading that. FinStreet is leading that Abu Dhabi's sovereign vision and bringing it to the forefront and bringing it to the world.
So I guess the question we're all asked to answer for our audience and guests is, what does the world look like in 25 years' time? And I'm hoping I'm still here to find the answer. So shall we go in order of age so that Sunita gets the last one? Garth, where do you think the capital markets will be in 25 years?
I think that the markets will always continue to think about risk and pricing risk. So you asked about structured products in private equity. That's all around tranching risk, and for more risk, you get more return. I think that you will continue to see that the evolvement of how risk is priced and how different pieces is tranched up of that risk and how that risk is then syndicated. My view is that the difficulty that retail has is accessing the private markets, and I think that that is something that you'll see change over time, either drive it back to the public markets such that you can tap the liquidity of retail. Today, the most liquid market in the world is the United States, and that's because it's democratized and there's a deep, deep retail bid. That isn't the case everywhere else, and my expectation is that the private markets will have to come back to the public markets, or they will evolve in a way that the deep retail bid will find a way to get into the market.
And do you think the internationalization of markets will happen at what rate? Do you think in 25 years, if we were sitting here?
Sorry, I couldn't hear you.
So, Michael.
Yeah, sorry. Yeah, okay. I'll try and
I'll pick that one up. Sorry. Yes.
I'll try and answer. I just want to build a little bit on that. So first of all, I completely agree. It has to be more plural. there are dynamics even in the most liquid market in the world, the United States right now, which is pointing towards concentration, and the concentration is going up and up and up for all the reasons that we know, and a lot of that flow is very passive. I actually think the private markets play an important role on the democratization part of this, and which again will make it more plural. There will be more people who take a fiduciary interest or almost like a stewardship interest in driving value in these assets instead of just passively watching by as the concentration increases. So I think private markets play an enormous role from that perspective. In terms of the capital flows, especially in this region, what we've seen is we've seen great success over the last 5 to 10 years, and so we expect more flows here, which is why obviously the region has sourced a lot of capital, but we increasingly also see a very interesting in-region investment opportunity. So when we sit here the next time, hopefully in 20, 25 years, I hope that we will also have stood up more businesses in the region and not but just provided capital from the region. I think that is a very, very healthy dynamic, and that flow can both go east and west from where we sit here today.
Absolutely. We sit midway between the east and west, Suniti?
Yes, I believe that UAE is situated in such a great location. I do believe that in the next 25 years, UAE will be the corridor for east and west international securities and commodities trade. That's something that we're also building at FinStreet, and there's 60 people in the office who are working every day to realize that dream. But more generally speaking, how do I see the markets in 25 years is that the asset classes, the lines will blur. We're already working towards private equity and public securities to work and coexist on the infrastructure. But also, it's capital is capital. It does not matter in which country you have it. It does not matter in which type of asset you have it. It should be completely interoperable, and that's something that our infrastructure provides. As well as, lastly, I think the regulators, the so-called referees of the game, need to recognize that international capital is a public good. So for the sake of international financial stability, there needs to be some level of regulatory coordination from the US, from Europe, from the Middle East and Asia. And that's how that flow will actually be perfected.
So my first dissertation was on Adam Smith. In 1776, he said the division of labor is limited by the extent of the market. Maybe the division of capital returns is limited by the extent of the capital markets. Thank you very much for your time. I hope we've shed some light on what the future might look like. I'm sure you have many ideas yourselves. Thank you very much for your attention.
Much, John, and your panelists for running us through what the future may look like when it comes to those capital market structures. Thank you so much, ladies and gentlemen.